this week on the podcast, we've got the team from Ellis Ridings Mortgage Solutions. I'm not going to go around and bore you with all the introductions, so I'll let them do it for yourselves. So we'll start off. We've got Simon.
Simon Rock from Ellis Ridings Mortgage Solutions. Been doing mortgages for coming up to 5 years now. Started in the corporate industry with a large corporate company. Moved across to Ellis Ridings Mortgage Solutions in January this year.
Fantastic. Thank you.
I'm Mark Ashworth, also from Ellis Ridings Mortgage Solutions as of September last year. Been doing mortgages for coming up for 4 and a bit years now. Again, started in the same company as Simon as well. That's me.
And Michael Ridings. I am the director of Ellis Ridings Mortgage Solutions. Been in the financial industry for 17 years-ish, maybe a little bit longer. Been doing mortgages or leading teams of mortgage advisors since. Ellis Ridings Mortgage Solutions was started in 2023, back end of 23. And that's where we're at now on our journey.
You must have started in the finance industry when you were 12.
Straight out of university, yeah. Don't let the lack of hair growth on my face trick you, yeah.
So we've got a good bit of experience. What we thought we'd do today is just look through and talk through the best do's and don'ts in the mortgage world. I think there's a few myths, a few things that are a bit controversial that we might discuss. What doesn't look good on your bank statement is probably one thing we'll go into in a bit more detail later. I'm sure you'll be interested to see what that is. But what we'll start off with is, when's the best time that someone should start speaking with a mortgage advisor? Is it when they are buying the house and they've already had their offer accepted? Is it before they start viewing? Is it a year before they're thinking of doing so? Open floor.
I think the best time, to be honest, is as soon as they start thinking about moving or buying a property. The earliest opportunity is the best opportunity. Yeah. Because you can actually get an idea of if what you're trying to achieve is possible.
Yes.
And it gives you a budget. So when you are going out to look at properties, you're looking at properties in your budget.
Because I think what some people often think, and I see it all the time as an estate agent, is people will come to me and they'll say, "Oh, I've looked at on my affordability calculator on Nationwide, or I've done this and I've done that, and this is what I think I can borrow." Why should they be speaking? Because that's free. Why should they be coming to someone that's potentially going to cost them money? Open question again of why shouldn't they just rely on the affordability calculator that you can plug in on Nationwide?
I think we see a lot of people who kind of go straight onto the Rightmove site. They see a property that they fall in love with. They click the simulator on there and they think, right, I can do this.
Yeah, how much is the mortgage simulator?
Forward. Yeah, exactly. So oftentimes we do speak to people who've made an offer and sort of then come to us, and unfortunately it's not quite how they thought it was going to pan out for, whatever reason it might be, credit impairment.
Your two Teslas on finance.
The two Teslas on finance, exactly, yeah. So I was glad that you led that question in.
Yeah.
Should it be when they buy? Because that is absolutely not the case. For me, and also doing it that far in advance, like Simon was saying, just to add on to what Simon was saying, it gives you a chance to kind of amend those credit card payments. Actually, I'm going to be in a better position if I've pay this credit card off, but I've got 6 months now because I've had a conversation with a broker and they've said that's going to impair me a little bit. I've got time to chip away at that balance and clear that away and actually pull the horns in a little bit. And
actually take that bit out of your savings, put it against your debt management or what you've got or against your credit. Yeah. And then, when I apply for I've got less savings to put into my deposit, but you're probably not going to put all your savings into your deposit anyway. Or if you do, it's a bit of a risk. That you're going to be left with nothing. But
there's definitely an element of people will, as you said, have an amount of savings and just think, I have to go and purchase this property. I'm buying a property for 250,000 and I've got a £30,000 deposit. Yeah. I have to put all £30,000 in. Whereas realistically, a 5-10% deposit, you're not using anywhere near that. Well, you've got at least 5,000 left over there, and that could be better utilised elsewhere to give better affordability, allow them to borrow that amount. But if you don't understand the figures in the first place and don't understand their actual current situation in the first place, then they don't know where they can go, what they can do. So I 100% agree with what Simon said. Speak to a mortgage broker before you actually start going viewing properties, and definitely before you start bidding on properties. Get an agreement in principle, make sure that it's solid, it's concrete. You can then put an offer in with confidence and you're not messing anybody around. No. And from another side of it, you just don't look like a bit of an idiot of putting an offer in and you can't get a mortgage in the future.
From my perspective, what I often do is, as an agent, you're kind of obliged to ask for where the source of the funding's coming from. It's always really good from my perspective if the buyer says, actually, this is my broker. We've gone through the agreement in principle I've got isn't one that I've just plugged in online and just got in 5 minutes. It's actually I've been through my broker. We've got my finances in order, and there's their details. They're happy to verify where we're at.
Well, it gives you more confidence in that offer when you
just
receive
look like
the
an
offer.
organised buyer.
Yeah.
Absolutely.
Gives your vendor that security of knowledge as well, safe in the knowledge that it's been done properly and it's been assessed.
And I always think that's exactly that. When I'm presenting an offer, you want to present it in the best light possible, right? If you don't want to go and say, oh, they think they're going to get some lending, they think they can borrow about this, and then it's pushing on that amount. They've got roughly this as a deposit, and you're like, oh, that's a interesting loan to value ratio that they've got there.
The other side of it though is also then the type of property. So if you are looking at, for instance, a flat masonette, you've got different criteria through every single lender. So we're whole of market, so we can go to that many different lenders. It's ridiculous. It grows all the time. But if you was to go to the likes of HSBC, they'd have a different criteria to the likes of Halifax, and that's two big, well-known banks that have different criteria based on just the style of house. And that literally on its own could determine the amount of deposit that's actually needed. Never mind anything else. So again, just having that, speaking right at the beginning, getting that agreement in principle, knowing what you're looking for. You might be a first-time buyer looking for a one-bedroom apartment. Okay, great. These are your pitfalls. These are some of the things you need to look for, like the length of the lease, whether there's a sinking fund on the property, what the service charge and ground rent is. Those types of things need to be reviewed prior to looking at it, because all of those play a part in the affordability as well.
Indeed. And then that sort of leads into the next thing that we were going to speak about is what should buyers do to get themselves ready to apply? So we've said about getting ready early, but what does getting ready actually mean?
One of the biggest things I advise my clients to do straight away is get a copy of their credit report.
And where can you get that from?
There's many online providers of your credit report. There's quite a few. There's ClearScore, there's Check My File. The three big agencies the mortgage lenders look at is Experian, Equifax and TransUnion. And they will all use those in different ways. So the best thing to do is go to a company that's going to provide you all three of those on one report. And it's easy to look at. You can look through it, see if there's anything you disagree with, anything you didn't know about, and you're getting yourself in the best position possible, and you've got an accurate amount of your debts then as well. So if you've got debts, it's going to have it on there. You can see exactly what you've got to pay off. There might be something on there you don't agree with or didn't realise, and then you can go and challenge that and do something about it.
We spoke about last time, didn't we? Of like that old phone bill from when you were 16 that you forgot to pay because you moved house at the end of the month that was £16, but you've now got a CCJ on your record that's unsatisfied.
And you'll be surprised how often that happens. And again, the biggie is if you've got that right at the beginning, because you're going to be running an agreement in principle, then you can do something about that. You can get it paid off. You can get it, in some cases, taken off your credit file. But if you try and submit a mortgage application without sorting that out in the first place, you're going to get nowhere. So it's definitely, I'd agree, get credit file up front. I personally always use Check My File. It's got all three of them on. Quite easy to read, quite simplistic to read, and from a customer's point of view, we can talk them through it quite comfortably, and it's easy to understand. And again, you can make quite easy changes to rectify it if you need to rectify it.
And just on that, looking across the three different checkers, so Experian, Equifax and TransUnion, some lenders will only use Equifax, for example. So one of the things that an experienced and knowledgeable broker can do is pick a lender where, it doesn't necessarily show on Equifax, it doesn't necessarily show on Experian. We can potentially pick a lender who doesn't use that search tool.
They're best suited to your
needs.
Situation.
I know Simon saved a lot of clients a lot of money by doing similar sorts of things in the past. There you go, mate.
Good little plug there.
The best example of that was I had a lady once who, older lady, she didn't know exactly what you're saying. It was about 3 or 4 years earlier. She'd swapped from 3 as a telephone company to O2, I believe it was at the time. And that last payment hadn't gone out. Now that was then sat on her credit file, but it was only logging with Experian, wasn't logging with everybody else. So when we did the first credit search for an agreement in principle, it failed based on this. So we then went to the next lender, got the agreement passed, but that didn't necessarily mean that that's the end of the problem. We obviously had to then go and tell her what to do to fix that. So she went off, fixed it, and then by the time it all came back around, actually the first lender was the cheapest. So we went back to them. We could go back to them because we'd solved that issue.
Yeah. So solving issues up front, and that's it. It's speak with your broker, get your credit file, work through it, through what's the best way to maximise and get the best product that you can, isn't it?
Yeah. It's also a case of having a look through your bank statements as well.
Yes. Yeah.
The amount of clients, when we do go through bank statements with our clients, we do a budget planner with our clients. And the amount of times I go, I was meant to cancel that. I don't use that anymore.
Me and my wife did that last night. It was quite funny. We've got a newborn, and in the middle of the night, she cried, and I looked at my phone, and Eloise had sent me a text. It said, Sky, Omaze, Sky Bet, The Sky Bet was because I'd had a winner, plugged to my father-in-law's horse, won me 53 quid off I think it was £2.50, so I'll take that. Sky had just gone up, and I'd forgot to speak to them last month to change my deal, so that had gone up from £89 to 107, and then Omaze, we just forgot to cancel the Omaze draw, and because we'd only entered it for the Devon and Cornwall houses, and now we've entered the last 3.
So now you could be winning houses anywhere in the UK.
It's 75 quid down the drain.
That's your Sky Bet cancelled out.
Exactly that. So it is stuff like that, isn't it? Like we'd only noticed it because she was trawling through our bank, being like, "Oh, we're skint this month," and it's stuff that comes out that you don't even think about.
It's a worthwhile exercise.
It is, and you'll be surprised the amount that you could actually do without council, get rid of. And the next thing you know, you've got more money in your bank at the end of each month. You can put that into your savings to go towards your deposit. It's all about maximising making your savings more efficient.
I've always whenever we're going through like a reapplication or something for our house, I've always thought, well, in the period of time prior to remortgaging or looking at doing whatever, I always think I can do without Spotify for like 4 or 5 months. I can do without that. It's those little luxuries that actually you can sort of plug yourselves up to get a bit of extra.
Those type of things are, so the best way of explaining how a lender's going to look at it is discretionary and non-discretionary. So what do you have to pay and what can you cancel at any point? If you can cancel at any point, a lender's going to look at it and go, not an issue, unless it's excessive. So if you are looking, first-time buyer, going to start buying your first property, you're living in a major city, and every morning you go and get in a Starbucks and a croissant, and then every lunchtime you go and get yourself a meal deal and whatever, and it's £15, £20 every single day. And that will probably be included in your affordability. If it's a one-off $7.99 for Netflix, you're fine, because it can be cancelled at any point, and it's just getting that understanding of it. And again, just by running through a bank statement, you can say to somebody, we're either going to potentially have an issue here or we're not. And again, you get people with things like gambling. People will come into elements like next year, World Cup's on. I don't gamble a lot, but I will have a gamble on the World Cup. I'll put a set amount of money in, try and make it last as long as I can for the World Cup. And that's just my bit of fun, what I do. Yeah, exactly. I'll fail on day one. I'll get too cocky, think I know too much about football. Not happening. Out I go. But with that, if it's just in small stints, then again they're not fussed. If it's £5-10 a month and you earn £2,000 a month, then it's manageable. It's doable. Everything's about excess when it comes to looking at your bank statements. And again, just reviewing that early doors can, as you said, you either nip that in the bud or you can alter the lifestyle element a little bit beforehand. But definitely worth reviewing before. Definitely.
It's just a good exercise to do anyway, because I think everyone always underestimates how expensive running a house is going to be. You often think, I remember doing it before we bought, and I'm an estate agent. I remember thinking, I pay X amount in rent per month, and that I'm fine. My mortgage is going to be roughly the same. It's still more because you've just got way more that ends up going out in terms of like your insurances, everything. Like the other month we had all of our insurances. We're on a multi-policy, but it was like dog, cars, house, everything all in one, and all of that stuff all comes in at once. Of you're applying for your mortgage, okay, and you've now got it, and you're going to complete. So you've got your insurances, you've got everything is going to come in one big lump sum, and your first month's payment's probably going to be more than what you'd normally anticipate. So you've got to have that buffer in any way, just to cover your first month. I remember saying to my sister when she bought, I was like, enjoy your first month because you'll be skinned.
Yeah, that's one of the things. Definitely, I'll always try and tell clients that when you're first moving into your property, have 1 month in your bank account before you move in, because you're probably going to need that month and your next month before you move in anyway. Just as you said, dates trying to correlate and catch up together. Yeah, that can be a killer.
We do go as part of the process. We will, as I say, do a budget planner. We do put those figures in there on how much things are going to cost. Because let's face it, we do want a bit of money left over at the end of each month. No, it's not fun just working to pay a mortgage and bills, and you can't afford to do anything else that you'd normally do. So that's where we get that balance right. And by talking to a broker, they can advise you on potential bills, make sure you've got that net disposable income at the end of each month, so you can actually go and enjoy your life. Otherwise, it's just not going to be fun.
And that informs you of what sort of house you should be buying. We do it all the time. I'm a religious right move scholar because of my job anyway, but Eloise will kind of sit up there at night and she'll just be scrolling. And now we've got the little one, she's like, oh, we can probably live in this house for another 2 years, then we'll definitely need a bigger one. And I keep saying, actually, let's just wait a minute. You want to go back part-time, so let's see what that looks like first. We know what we can afford now with your full-time wage and my full-time wage, but we don't want to. Definitely don't want to be kind of sat there in my house resenting it because I've overstretched myself, and I could have sat down with someone prior and said, actually, no, you can't afford 500. You can be at 450.
The biggie is not just what you can afford; it's what that actually looks like on a monthly basis. You said so. And even literally yesterday, I was having a conversation with somebody. They could afford up to £250,000 worth of borrowing. What that looks like on a monthly basis was in no way, shape or form affordable. And actually at 200,000, so all we did is then worked back to what their budget was going to be. And at 200,000, that's where they felt comfortable. The bills were comfortable. So now he's starting his house search on 200,000 as opposed to what he can actually get. But then from our point of view and from his point of view, that's very good from a lender's because he's not stretching his affordability. He's more likely to be accepted. His deposit is suddenly now a bigger chunk against the purchase price. Everything works in his favour, and he knows that he can, as you said, buy it, pay the bills, and actually live. Have a haircut, have a pint in the pub, or whatever he wants to do,
and manage varying interest rates. That's something we've seen drastically over the last few years, isn't it? It was fine doing it. I've seen people going out at my age at 30 something getting 600 grand mortgages. That's all right if you're paying 1.5%, but as soon as that changes and your variable rate comes up at the end of your term,
it's a jump and a half.
And your prices have gone down from when you bought if you bought in COVID.
So real life for myself.
It's a shit sandwich, isn't it?
It is, We remortgaged right around the time of Liz Truss, and luckily I'd done it a couple of months in advance. But ours went up by £200 a month. It's not that easy to come by, especially when my partner, similar to you, went on maternity leave and then dropped her hours down, sort of thing. So
you've got to get a lot of mortgages through.
Any more leads?
He's working very hard during that time.
I haven't slept for.
We'll put your email at the bottom of the tagline.
That'd be appreciated.
And then, so one thing that we always get asked, and I always ask a first-time buyer this if I speak to a first-time buyer, is, have you spoken to a broker? Because I think that's the most important kind of part, is when you're just getting on the ladder, is getting really good advice. And it's the first time you've done it. Yes, your mum and dad will be able to provide you with advice, but the likely time they got their first mortgage will be 30, 40 years ago, and it's a very different setup. What sort of help is in place for first-time buyers at the moment in the mortgage market?
Well, coming to a broker, obviously, we've helped hundreds, if not thousands, of people purchase their property. There's not much we haven't seen during that time, so we can really hold their hand all the way through the buying process, every step of the way, and give them guidance at every step. Some of our first-time buyers are in regular contact with us because I've just had this. What does this mean? What do I have to do next? And we can give them that confidence and that assurance. But as far as what the lenders do, there's a lot of really good first-time buyer mortgage products out there. Some of them have got cash back as well, which is really handy for first-time buyers, because when you're moving in, you just realise, I've got to buy that washing machine or that sofa or something, and you've got a bit of cash back to enable you to do that. And there's some really good first-time buyer rates out there as well. So that's a really good sign of things. As far as the biggest concerns, deposit, there are some really good low deposit mortgages, or even if you're in renting, zero deposit mortgages out there as well.
One of the schemes that I worked on with a friend of mine yesterday was two things actually. So additional lending. Once you earn over a certain threshold, a couple of lenders have something called reach products where they can lend instead of sort of roughly 4.5 times your gross annual income, they can boost it to sort of 5.5 times, depending on your level of income. Because you're young enough to stretch that term a little bit further, they figure that they can afford and you're comfortable enough.
The risk management's fine.
Yeah, that's exactly it. Yeah, so they can lend a little bit more, potentially if you earn more, and that's not just exclusive to first-time buyers, mind you. That is home movers too. But the other thing I was going to say is about a new build site that this particular couple were looking at. Builders will sometimes offer sort of 5% cashback potentially, or 5% towards your deposit. For these guys, it enabled them to move from a 5% deposit where the lending was a lot stricter to a 10% deposit where they've actually boosted not just their affordability in terms of the lending amount that they could take, but also kind of lowered the monthly repayments down because the interest rates had come down as a result of now having a 10% deposit instead of a 5% deposit. So
that's good.
Yeah, that was a really, really useful thing for those guys as first-time buyers.
And so one of the other things that we always see is your first-time buyers, but then something I've seen lots of recently, especially with the rate changes, is when people come to me and I say, so how are you going to fund this purchase? We've got the sale of our house, which we've got good equity in, then we're going to port our mortgage. So porting is one that I always find quite fun because I think everyone thinks they can do it.
Yep.
They can just drag their rate across with them, take their mortgage with them. That's not always the case though, is it?
Not at all, unfortunately. There's a
pain behind his eyes, as he says.
There's a bit more to it than that, unfortunately.
We can cut it and make it go back. So we had a little bit of a mishap there. I kicked off as we were talking about porting mortgages and just chucked everything out of the way because
he was furious.
Furious about it. No. But,
Calm down now.
Anyhow, calm down. We're going to go back to talking about porting and why sometimes it's a bit harder than people anticipate.
So, well, when it comes to porting, so just to go back to it after the big kick-off session. It's not as simple as it sounds. So first off, there's a few different elements. So first off, can you actually even port your product in the first place?
Yeah.
So when you take a new product out, you'll be told yes you can or no you can't. And that first off is your biggest determining factor. So yes, you can ring up the lender and say, can I port it? Great, fantastic, the product's portable. What then goes on from there is first off the next part, the type of product you got. So as an example, I've had somebody recently that's got a shared ownership property, selling the shared ownership property, moving into what would be a standard residential purchase. Now, they're unable to port that product because that is a specific product for shared ownership. Now, again, some lenders will let you do certain things. So I've actually managed to be able to get her to have her early repayment charge waived as long as she stayed with the same lender, but we can't take that product with us. So we've managed to save her $3,500, which is great, but she can't port that product. So she had to do a full new application regardless anyway. The next part of it is most people, if they are porting, if you're doing a sideways move, it's never just pick up the same amount and move it across. It's pick up that amount, move it across and borrow more on top of it. All of that is a full affordability assessment. You've got to go back through your bank statements, pay slips, the whole lot, prove you can still pay for it, everything else that goes with it, and it is a full application. The other side to it as well is, just to throw another part into the mix, is whatever your current product is. So let's say, for instance, you bought a property 5 years ago, you initially took out a 2-year fixed, and then at the end of that 2-year fixed, you took out a 5. So you're now 3 years into your 5, so you've got 2 years left. You've then got to try and match up, knowing that it's probably going to take 6 months for this whole sale and purchase to go through. You're then taking an additional element for borrowing, and then you've now got one product that's now got 18 months remaining, and you've got another product that's got 2 years. So every time now you've got to do 2 remortgages until you can join them back in alignment. Sorry, excuse me. Which again, it just can be tricky with certain lenders. And can cause some issues.
The other element to that as well is if you're going the other way and you're downsizing, you don't need to borrow as much. Now, porting, as everyone knows, is trying not to pay an early repayment charge. They're going to port their mortgage because they don't want to pay an early repayment charge. And they think, I can just reduce my mortgage down. That'll please the lender. Great, reduce the. But actually, if you've got a £200,000 mortgage and you only need £150,000, most lenders will allow you to make an overpayment of 10% each year. So that's £20,000 taken care of. The other 30,000 that you're going to reduce your mortgage by will be taken as an overpayment and will be subject to an early repayment charge.
Okay.
So you could still end up paying an early repayment charge even though you're porting. Not the full amount, it's just it's partial early repayment charge on the overpayment that you're making.
So all of this really links back to where we started, doesn't it? About you should be speaking to your broker when you're thinking of starting doing something.
Absolutely.
So you know where you stand, what your options are. Of actually, sometimes it's more efficient to just deal, or you've got to deal with the early repayment charge because that's what you're doing. And it might be better rather than porting to say, okay, well, I'll deal with the early repayment charge and I'll take out a new product that's more suited to that property.
Yeah, correct.
I've got a client at the moment that's got five, 6 parts to their mortgage.
Yeah.
And they've got 5 elements to the mortgage, all on different dates, terms, and everything else, and they just want to try and condense it. So we've made the most efficient way for them to be able to do that, and it's still cost effective actually to do it in the way we suggested, and actually go to a new product, new lender, and it's still just as cost effective if they were porting. So that was the best way for them, but they were just ready to port their entire 5 parts of their mortgage across to their new property.
Yeah. I think a lot of it is just you guys are financial advisors. That's the reality of it, is that you're advising people about their finance. You might not necessarily say that you wouldn't say I'm a whole aspect of financial advice, but it's a really key aspect of most people's biggest expenditure is their mortgage.
It's the biggest debt they're ever going to have in their lives, and I think the key is going through a thorough fact find and understanding what this person's real life looks like day to day. So when you're talking about, can I cancel the Spotify, or can I cancel the Sky account? Yeah, I can, but can I cancel the kids' swimming lessons? Probably not going to do that. So actually, if I do borrow this amount of money, does that mean we're living without certain things that we've been used to and that we would want to be doing with our lives on a day-to-day basis? So, yeah, I do think that's a key point, is that we're trying to work out the best scenario for individuals and how they want to spend their money, but also live their lives in the real world as well.
Yeah,
we did have it's a while back now, but genuine case. Somebody came in, wanted to purchase a property. He was a Chelsea season ticket holder.
Up the Chelsea.
Yeah. Oh, in
straight away.
Yeah. So
Go watch it.
We told
they were
him
only good in 2010.
Wasting your money. Mourinho's gone.
Whoever another strop or any more equipment broken.
So we reviewed his mortgage and looked at it, and a season ticket is not cheap. It's a few hundred quid every month. And the property that he wanted wasn't affordable with his season ticket. And the first question we said to him was, well, could you cancel that? And he just turned around flat out and said, no, I don't want to. I work hard every single week. Football is that's my out. That's where I go. I go, Stamford Bridge every single Saturday that they're playing at home. See them lose, obviously. Yeah. And from there, he was like, no, that's what I want to do. So that was an important part of his life. So we adjusted it, and we had to tell him that you can't afford to buy this house. And he was actually genuinely more than happy. He said, I want my own place, but that is more important. That's what I live for. I go with the lads, have a couple of beers, go and watch the football, and that's what I do every weekend. So
he probably got declined because he probably has a couple more than a couple beers.
Yeah, I mean, yeah.
50 quid withdrawals at 3 a.m.
Yeah. Don't get me wrong, there was a couple, but he ended up happy just by taking that into account. He's now got his own house and he gets to go to the football. Yeah. Done. So he's had to do a bit of a compromise, but some people would compromise on that and just cancel the football. He was flat out, no, I'm going, I'm watching, and you're not getting this off.
If you do want to sell it, though, I will buy it. Talking about £50 withdrawals at 3 a.m, I think maybe it's time we had a chat through kind of things that crop up on bank statements that can be problematic in the buying process. Now, there's a few things that spring to mind, but you guys know better than what I do of
There is
some funny ones that you might have seen, and
there's a few awkward conversations we have to have sometimes. It's worse when there's a couple sitting in front of you, and you've got OnlyFans on the bank statements. And you're kind of like, what's these?
Are these necessary?
I don't know what it is. So you have to explain.
You're too innocent. You're too innocent.
It's when he's doubling down and you're saying, is it a necessary expense? And he's like, yes.
And it's like £400 on a monthly basis. Okay. The season ticket I can sort of understand. But
There's a reason Lily Phillips buys in cash.
We joke, but it is coming up more on a regular basis now. We're seeing more of it. I think Michael touched on the gambling side of things earlier, with gambling being so accessible on your mobiles, and you just think, oh, just that extra one, just another one. Lenders, obviously, we're talking about habits, addictions, even in some cases. So that concerns lenders when they're looking at your finances. If they think, crikey, this guy's just gambling all the time, the chances are that could continue, it could get worse, it's going to concern them, worry them, and they're more likely to say, actually, that's not for us.
Don't get me wrong, it's whatever your vice is, whether that is OnlyFans or whether that is gambling or
Chelsea.
Or Chelsea, yeah. I mean, it seems a bit of a strange category to put them all together in, isn't it? But if it's £50 a month and you earn £2,000 a month, they're just not even going to bat an eyelid. That's not an issue at that point. So no one's ever going to say that is. But when you are starting to clock up the £300-400 a month, which we do see regularly, that's when lenders will turn around and just say, no, we're just not happy with this, and they will just cut it off there and then. There's lots of different things you can do, as you said, prior to going for a mortgage, and lots of habits you can change, and just making your bank statements look a bit more appealing to a lender. But even from your own point of view, that little reality check of going, okay, well, I do spend whatever amount it is on whatever my vice is. Well, can you do that when you've got all these additional bills? So by you actually having, as a individual, you having that 3-4 months before buying a house of not using it, you can actually get into good habits. So when all the actual costs do go up, you're not putting yourself in debt or anything to try and keep up with it. So,
also references as well on certain transactions.
We spoke about this at the pub, didn't we?
We've had this, yeah. So, I had a client who had booked a hen do, and of course all of her mates were sending through things like, sex toy payment and all this sort of stuff on her bank statement. Now, as funny as it is at the time, it doesn't really help with lenders, so just be mindful of that. I think you've had ransom or kidnap money.
Ransom money, kidnap money.
Drug money.
Drug money, yeah.
So just be a little bit mindful about that before.
So if you're collecting the fines at the football club, you're not getting a mortgage anytime soon.
Basically, have a separate account.
I remember I did it when I played at Tottenham, and I had a Monzo pot that I'd set up, and if I'd have bought that Monzo pot to you, you'd have been like, this guy should be in jail.
I mean, you've genuinely seen it all. So you've cocaine, as you say, sex toy refund, you name it. People have got a good sense of humour, and they throw it in there, and it is funny until somebody's going, please sir, can I borrow £300,000? Here's my bank statement. It just sort of doesn't really go together.
No. Trying to look like a responsible individual and doing everything you can to not look like a responsible individual.
Exactly.
So other things is overdrafts. They are there for a reason. People use them. That's great. They're there for those months where everything, as you say, seems to fall in that 1 month, and you go into your overdraft. And again, it's all measures on how much you use your overdraft. If you're constantly in it, month after month after month, they're going to look at the way you manage your account and look at the ways you manage your finances. So that could become a potential issue. A lot of the time, it might be a case of, look, you've got some deposit money, you might be better off actually getting yourself out your overdraft all the time. Put a bit less in, and it's going to look.
Question for me of what would be preferable then. So let's say you're short at the end of each month. Is it better to go into your overdraft or use a credit card?
Depends on the amount.
Yeah.
I'd say if you've got a £1,500 overdraft and you're at £1,500 every single month, then you need to slowly work your way out of it. So every month, just don't spend £100. I know that's easier said than done, but bit by bit, a logical amount come out of it. Yeah. Realistically, spending a little bit on a credit card and paying it off, it might be better to look at both. But again, just looking at someone's spending habits, someone's bank account, where's the money going, what's it being spent on? even just simple thing like you said, like your Sky's just shot up from 80 odd quid up to 100 odd quid. Yeah. Well, even just a simple saving, like, I'll tell you what, don't change anything, just go and sort your Sky out. You've saved 30 quid a month, and actually, if you spend exactly the same, your overdraft is going to be £30 less next month because you've just sorted Sky out.
They've got simple things like that. Fourth trimester woman on the phone this morning.
Yeah.
So God help us on the end of the other line.
Good luck. Good luck if you work at Sky.
Sending the big guns.
Yeah. I was just saying to me, she was like, "Oh, do you want to phone them?" I was like, "I've got a really busy day today." She was like, "Oh, because most of the bills are in my name." She's like, "Oh," and I was like, "Oh, this is one where it's joint. So you can take this one." And she was like, "Okay, I'll try." I was like, "Yeah, they're not going to end up having a happy phone call."
No, especially
no email to tell us the increase. You've just stopped my baby going swimming.
Yeah. I mean, if anything's going to aggravate a mother, it's going to be that, isn't it? Anything with a child. But no, I mean, some of the other more simplistic things are, as we said earlier on, touched on it before, lifestyle amount. So excessive lifestyle. So if it is going to the pub every Friday, Saturday, whatever it is, and that is constant every week, and it is, well, I mean, back when I was going out every Friday, Saturday night, it was probably 40 quid on an evening. It's probably about 200 quid nowadays with the cost of...
Adjust for inflation. You've been in banking 17 years.
Yeah, I know. Yeah. I know. I wouldn't believe I'm 40 next year. It's worrying. Or I'd like to think it wouldn't be. But yeah, it's all of that excessive stuff. So as we said, like massive amounts of Costa, massive amounts of going to the pub, massive amounts of eating out, massive amounts of just spending clothes shops and all that type of stuff. If it's excessive and it's £600-700 a month, which you do see, then they're just going to look at that and go, that's a long-term lifestyle choice. How are you going to change that? And how are you? Most people go, oh yeah, I'll change it when I bought a house, but how is that actually going to stick? Because you've been doing it for that long. That's the norm.
And I think that's what I sometimes see from people that are maybe, say, living at home with parents still and buying their first home. Got a big amount of disposable income. If you're living at home and let's say you're on a 40 grand salary and your mum and dad are kindly not charging you any rent, well, it's a lot of money that you've got freely disposable to you.
Absolutely.
You've probably got a car on finance.
Yep.
You're probably going out with your mates a fair bit, dressing nicely. You've got your lifestyle. You've got a David Lloyd premium membership. So that's 150 a month.
Booking holidays 2 or 3 times a year.
Yeah, exactly. A ski holiday at Val d'Isere where you've just blown 3 grand. So all of those things, if you've been doing that for 4 years because that's the lifestyle you're accustomed to, yes, you might have still saved a lot of money to put down a decent deposit, but you've still got a habitual spending.
Yeah.
And I guess that's what the bank are going to look at, isn't it? So, okay, look, you're 30 years old, and you've got a really great deposit, but your car finance payment, which you've been able to manage comfortably, is £500 a month. Yeah. You're tied into that.
For another 7 years. Yeah, because you decided to go and get the brand new Tesla truck or whatever you're going to get. Yeah. It's sort of going, and that's again in your affordability, and it's in your affordability for however long. And when you look at the basis of lending, so let's say the average rough amount is 4.5 times income. So if you was to take a £500 a month outgoing, well, over the course of a year, that's what, 6 grand. So you times that by 4.5, that's how much you can now not borrow because of just that one bill. And if you put that onto, as you said, credit cards because you're going on holiday or you've got nice clothes, if you suddenly have £1,000 a month outgoing, that's £12,000 that's going out, times by 4.5, that's what, in your 40s, 50s, £1,000 that you cannot borrow now. Yeah, and that's what's taken away. So, and it's just that general understanding that people don't, I would say people don't know, but not out of ignorance, but just more out of education, I suppose. There's not a massive amount of education about how mortgages work and how the lending element works and how finances are put together. And I do think that is something that personally needs to change.
I think it's something that should be taught in schools. Like financial literacy should be something that is especially sort of in that post-16, you've obviously got to be in school or education now, haven't you, in that age demographic. It's not like when we were at school and you could leave at 16 and go and get a job. But you've got to be doing something. They probably should be teaching you about getting a mortgage, managing credit, all of that. Why you can't just ditch off your mobile phone and not pay it. One thing we spoke about before that I thought was really interesting that I didn't know about this, it's impacted me. Eloise hates it because I'm always looking for new cars, and now that we've had the baby, she's taken my car and I've now got hers, and I now want a new car because I don't want her car. The one thing we spoke about was the difference between a hire purchase and a PCP on your mortgage applications. And I've always just thought, I manage that monthly, that's fine, and that will be the monthly amount will be what's deemed on my credit aspect.
Yep.
So I didn't know whether you would just a bit more detail about the difference between a hire purchase and a PCP on
Yeah.
how that can
So
impact.
it's more the personal loan element against the higher purchase. So let's say we've got a £30,000 car, just for argument's sake. You take a personal loan that's for £30,000 and you pay X amount per month over 5 years. Whatever that X amount is per month is obviously taken into your affordability, but the amount outstanding in the background is also there in your affordability, because that is a full amount of debt that you'd be paying back. With a PCP, you'll normally get a lower payment. So instead of paying £700 a month, you're paying £250 a month or whatever it is. Because at the end of that PCP, the idea is either hand the car back and you've got nothing left, it pays it off, or you trade and get a new car and off you go. So whatever that total amount is in the background on a PCP, because of the way a number of lenders' calculators and algorithms work in the background, they won't be taking into account that the full outstanding debt. Whereas when it's on a personal loan, they will. So as an example, bought a car for £30,000. There's 25 grand left in the background as such. You're making your payment. On the PCP, it'll count the £250 a month, but it won't count the 25 grand. On the personal loan, it'll count the £700 a month or whatever the amount is, and the amount in the background is there because you have to pay that back, because that's a full loan. Whereas that one is effectively a lease agreement. You're going to hand that car back and then just get a new one, so it'll only take into account that monthly payment.
Yeah.
Which makes a big difference.
So it's that was one that we were thinking about. Roughly, when we're looking at buying a car, we're thinking 200 to 250 a month. That's what we're looking at, is that we can manage that. I'm not going to splurge 20 grand of my own cash on a car. But as we then looked at it, if we want to remortgage, if we want to buy somewhere new in 2-3 years, I don't want a 5-year HP still there. I want the facility to be able to actually say I almost want to tie the PCP in with when we're going to be moving. I'll just ditch the PCP when we come to do that. We'll get onto one car for a little bit, and then that's going to up our borrowing amount again.
Yeah, 100%.
So I guess it's just been clever with, and that's something that I hadn't even considered. Right, and it's like, well, actually, just one chat at the pub the other day.
Yeah, and suddenly you go, I can borrow an extra.
I can play around with. Yeah. Els, I'm going to have to get the PCP one, which is newer. Oh, that's nice. What a shame.
Unfortunately, yeah. I'm going to have to get a brand new car. What a shit.
I've got to get an M2.
Yeah.
It's the only option.
Mortgage told me.
Yeah. I've had mortgage advice, been told that as part of the mortgage, I've got to buy a new car. Yeah. Done. Okay.
Ibiza's just not working anymore.
Yeah.
Right, next bit, because we've got a few more bits and we're rushing on time. So one thing that I'm a big advocate of, and I've told my sister off about this recently, is having cover on your mortgage. So what I mean by that is critical illness and life insurance, of why it's important. A lot of people, and my sister was one of these, she sort of said, well, I'm fine. I don't need it. I'm fine. I'm 28 years old and just bought my house. She subsequently got a heart condition, which is now it's a declared illness, so it's obviously going to be much harder. She can still get life insurance and critical illness cover, but it's not going to cover the one aspect.
The
pre-existing condition.
Yeah. Hindsight is a wonderful thing.
Yeah.
If I knew how much cheaper it was to get life insurance in my early 20s, I would have done it then, and it's much cheaper. The older you get, I'm in my 50s now, so the older you get, the more zeros they put on the end of your monthly premium for your policy. Well, to be young again. But yeah, I mean, I know Michael's got an opinion on this. I think I agree with it. Is really life insurance minimum should be mandatory when you're buying getting a mortgage and you're buying a property.
Lenders, it is a condition, isn't it?
I don't think it is, to be fair. No, I think it's suggested. I think HSBC have on the illustration that it's suggested that it's done and it's put in place. But no, the only mandatory one you have to have is buildings insurance. Yeah. You don't even have to even cover your contents, which sounds daft because the price is that cheap when you're taking the buildings in the first place anyway. But I just think, especially if you're buying on your own and you've got no dependents and you're doing what have you, then fine, I can sort of understand that from not taking any protection out, because it's just you and just you at risk. The moment there's a secondary party, or the moment there's children, the moment there's anybody else that's going to be impacted if you're not there, 100%, my personal opinion is life insurance as a minimum should be mandatory at that point.
So what would, for the average person that hasn't got life insurance and hasn't ever inquired about it, in relation to your mortgage, what will your life insurance cover? So you pass away, what's covered under the policies.
Pays off the mortgage.
Yeah.
Done. Literally as simple as that.
Yeah.
So you've got Mr. and Mrs. There's obviously a few terms and conditions, but majority of the lenders that we all use, so we've got a panel of lenders, and the payout rates are along the lines of like 99.5%. They're right up there. So the only normal caveat in that is, and a bit of a morbid subject, but it's the easiest way of explaining it is just be blunt with it. There's a normal caveat in there is if somebody commits suicide within the first 12 months, it doesn't pay out. That's why it's not bang on the 100%, because unfortunately we do get that, and that, it does happen. So, but 9 times out of 10, you've got, let's say for myself and my wife, we've got life insurance. If I was to pass away, it would literally just pay straight out, direct to her, pays off the mortgage, done. Her and the kids are finding the house, sorted, no messing around. And I do just think that personally, that should be there. As you said, there are critical illness, there's income protection, there's lots of other things that can go on top of that for added protection. But yeah, that for me is the one.
From my personal perspective, I feel like if you're taking a mortgage out, you're doing it for security, because you don't want to rent anymore. You don't want a for sale sign going outside your house and having to kind of move. But I also feel like it's such a long-term investment to eventually own an asset outright, and hopefully pass it on to future generations of your own family. If you don't have that life cover and you don't have that ability to kind of repay that mortgage in the event of you passing away, then you're not leaving them with an asset, you're leaving them with a debt, effectively.
Well, especially with markets that fluctuate like what we're in at the moment, is if you've taken out your mortgage, as we said earlier, in like 21, 22, and you've got a really big mortgage and your house isn't necessarily worth what you pay for it at that time, you're still going to get a payout and actually going to be able to leave something.
Yeah, 100%.
What surprises me is the amount of people that actually spend a fortune insuring their pets.
Yeah,
their pets are more insured than they are.
Phones as well.
And the amount of money we spend on insurances for cars, phones, pets, but we don't insure ourselves.
Yeah. And it isn't actually as much as what people think it's going to be.
It's not. And even just getting that, we do get clients that don't want to talk about it at all. And they just close down.
Not touching it.
It is a difficult situation to have, and we do ask our clients to have some difficult conversations between themselves. We are talking about, death, critical illnesses. What do you want to happen in those circumstances? So it is a difficult conversation for people to have. Completely understand, but it is a really important one. They've worked hard to get themselves in a position where they can own their own home and have a mortgage and for the future, but they don't protect themselves, which for us as mortgage advisors is just baffling sometimes.
Do you think it just seems daft and naive? It's when you think about it from a detached perspective, if someone said to you, okay, well, when you die, if you pay £60 per month, £70 per month, you can ensure that your children and your partner aren't going to be left with a load of debt and no income. It's like in our household, I earn 2/3 of the money. So if I pass away, what's Eloise going to do when she's got a child and she's not going to go back to work full time because someone's got to look after the child? So you don't want to be left in that scenario. And I think if you die with a clean conscience.
the best answer, and I think the most ridiculous answer personally is, it's all right, we've got my parents, they'll help. You sort of think, okay, well, average first-time buyer nowadays is 30-ish, in and around that level, which means average parent age is somewhere around 50 to 60, there or thereabouts. So they're basically saying, if there's any issues, parents will help us pay for the mortgage. Now, at 50 to 60, they've probably still got a mortgage of their own. They're still probably obviously working, but they're not going to be for very long. That mortgage is going to be paid off and then they're going to be retired and they're going to be on a pension. And you're thinking then that they're going to, just drop everything that they're doing and pay your mortgage. It's not just your mortgage, it's your council tax, it's your gas, it's your electric, it's your water, it's your food on the table, it's all of that. If you take away that biggest bill of the mortgage, then there is state support and help and, as you said, part-time income and so on that can then facilitate the rest of it. But with that biggest bill in there, it's pretty much impossible, which means that the house just being sold, which means not only if you're, especially in the scenario, and this is when it sounds a little bit brutal, but it's the honest facts. If you've got Mr. and Mrs., 2 kids, Mr. passes away for whatever reason, a car accident, what have you, off he goes, he's gone, and there's no life insurance in place. You've then got mum who's explaining to 2 kids that dad's no longer around, And also, we can't now afford the house that you is the only safe place and place that you feel comfortable in. We're now going to have to sell it, uproots as well. And that disruption for the children is ridiculous.
Yeah.
Like that is a lot to take.
And I always just think, if you ask someone outright, you can avoid all of that and you pay X amount per month.
£20 roughly for the average first-time buyer of life insurance, just life insurance.
Nuts, isn't it?
Yeah, it's crazy.
And I think the same with critical illness. Like, we pay quite a bit in our critical illness cover, and we've had it track our earnings, and so as we've gone up, we've not just kept it at when we initially took out. We've kind of made sure we kept going. You just think with that, don't you? Unfortunately, I'm only 31, but we've got friends that have had serious medical conditions and friends that have had cancer and have had to take time off work. That's not so. If you're going through all of that, the last thing you want to be worrying about is, can I pay my bills?
Yeah.
So I just think for the cost of what it is, and when you look about how much you spend on going on the piss, like you go out once in a month. Well, you could have covered all of that.
You get one fancy bottle of gin every month, and that's your life insurance covered, isn't it? You just literally do that, drop one bottle of whatever you're drinking, or take out one meal, or one Mackey's run, or whatever it is.
One takeaway.
And you just sort of go, that's it, you're done. Actually, you're covered for life, and your children are fine. But again, slightly opinionated on that one.
Your biggest asset is being able to earn an income. Yeah. When you've got a mortgage, when you've got a property, your biggest asset is your income, because that is what pays for your lifestyle, for your bills, for your family. So protecting that as well, should anything happen, is a really, really smart idea to do, a really good thing to do. And again, we get a lot of there's more clients that have just life insurance, and then they don't seem to look at the critical illness, the income protection. They think they've got suitable cover in place with just life insurance, which is life insurance. To have life insurance is great, because we've already discussed what that does for a job. But then we've got more clients wanting to insure themselves while they're still alive, so they can cope with anything like what life might throw at them, than life insurance, which is only good for one thing should the worst happen. Yeah. So we do tend to talk to our clients about protecting themselves from an early stage, to prepare them to say, look, we're going to have this conversation. It's going to be a difficult one, and expect to be spending this amount extra to give you that security. Yeah. We'll try and quickly, because we've only got a couple of minutes left, but we'll go on to a bit more of a happy topic. Not necessarily happy, but maybe a bit not quite as morbid. We spoke with big life events and things like that. So we spoke before when we were at the pub, just not prior to doing this. We're filming at 9:30, but we met prior. We spoke about self-employment and getting mortgages, but also sort of big life events like maternity leave, and actually how that doesn't have to necessarily impact you getting the mortgage that you were on your full-time salary previously. So I was just going to quickly bounce to you guys. Mythbuster, one quick bit of Mythbuster about self-employment and mortgages, and how many years books you might need to have. So if one of you, I don't mind who. Simon, do you want to take it? So a lot of people feel they need 2 years SA 302s or 2 years books. That's not the case. We can do that with a single year. Yeah. And it's just a case of come and speak to us, come and speak to a broker, and we can guide you through. We can have a look at your self-employed earnings and tell you exactly what is possible. But we have got lenders that will take 12 months book. And you did also say last time, if you're paying yourself in a tax efficient way, so if you're doing 12,750 and then divs on top of it, actually you don't have to necessarily go and adjust your salary payments to be 50 grand and then not claim your divs and pay more tax. You can. There are lenders out there, aren't there? That if you're limited company, if you're set up as a limited company, that is the most. You're going to speak to your accountant. They're going to tell you that is the most efficient way to withdraw your money from the limited company, paying the least tax. We can work with that. That's not a problem at all. There are some lenders out there that also look at your share of the profits, as well as what you pay yourself as a basic wage. So there are different ways that different lenders will look at different figures to calculate your affordability. Net profit, return profit in the business. He said salary, dividends, whichever way your setup is,
there'll be a lender which you tailor to maximise that.
Although cash backhanders probably aren't the one.
Yeah.
Don't skip on the VAT if you're going to actually pay your VAT.
It's whatever's declared. Let's make that a point. Yeah,
you can't get a mortgage if you've been paid in cold hard cash.
Yeah,
although it's nice.
Yeah.
Not that I take cash payments. So that's one aspect of your self-employment. I think the final thing we'll end on, as I know it's impacted a lot in my life and a lot of my friends' lives recently, is mortgages with maternity leave. Because it's often a time where you do need to move.
Yeah.
So
it's an upsize, isn't it?
Yeah. You've outgrown your 2-bed flat, or you've got your house, and you're actually thinking, okay, well now we're sort of in a position where maybe we want to be close to the grandparents, so we are going to move. But oh no, my wife's on maternity leave for 9 months a year. That's going to impact what mortgage we can get.
So as a rule of thumb, lenders can't discriminate against people being on maternity leave. What they would look to see in most circumstances are the pre-maternity pay slips. So the earnings just prior to going on maternity leave. And in some cases, most cases, they would want to see a letter or some sort of document from the employer to say that Mrs. is going to return to work on the same amount of hours as it was before, so we can kind of match up the previous pay slips as to what the future pay slips are going to look like. Yeah. And generally speaking, that should suffice as kind of enough evidence to get you over the line. So it is, you will be a little bit tight in the interim period, obviously, if you kind of move during that mat leave, but it's not something they can discriminate against. So
one thing that I'll clip in, and this is just for my wife, is that your employer doesn't have to say that you're going back for the same amount of hours.
Yes.
It's not dropping your hours. More hours.
For your
As
wife.
A teacher, you actually need to work 6 days a week.
If anything, overtime in there now as well. Second job if needed.
Yeah, absolutely. So all of the hours. I'll be a stay-at-home dad. Isla can go and learn to play golf on her days out with me.
Oh, you're a pro golfer.
I always think that actually, me and my friend were talking about this on the golf range of a day. I think now I would rather that my child be a golfer than a footballer. I think it's better lifestyle. There's more cash. So if I'm going to be a pro sports parent, I'm going to be a golf parent.
Go for a golf parent.
You just get to go to golf courses around the world. I don't have to go and watch Chelsea and be depressed.
Yeah, I mean, to be fair, that's good. You make a valid point there. Yeah, I'm more leaning towards the golf.
I was just saying to Ethan, who's doing the filming earlier, don't have to go and watch Plymouth. I think I'd be going golf parent.
And as a Man United fan, I could probably go.
It's
probably a good. It's probably a good time to go watch golf.
I'm a bit late now. Both my children are in their mid-20s, so if they were going to do something, they would have done it by now.
Golf.
But for me, I would have encouraged my son to go racing driver, Formula 1, that route.
Although I did watch I watched Drive. I got quite into Drive to Survive. And do you see when there was that crash for Grosjean, he literally set on fire? I'm not quite sure I'm going to be advocating. I watched Drive to Survive and I've let them all go and do it.
It was how he got out of that was just absolutely insane. But the guys know I'm avid Formula 1. So.
Although the Grand Prix the weekend was bloody boring. Baby woke up early and I was like, what's on Sky Go?
That's exactly what I did.
£7 a month.
Got to make the most of it.
And it's a Japanese Grand Prix. I was like, it's a good front row. There'll be some good racing in that. I think it's the first time in like 20 years that the front 6 haven't changed places. So the qualifying and the 6 were just in the same position the whole way through.
Yeah.
So Grosjean had some critical illness insurance.
I hope he did.
And
protection.
I think we'll end on that point. So there's lots of really good information there for you. What we'll do is we'll put all of the guys' contact details in the link in the bio. You will see us sharing a few clips along other various social media channels in the near future. But any questions, please don't hesitate to get in touch. Thanks very much.